Hi, and welcome everyone. Thank you for tuning in today for today's short CFO Symposium webinar. We will be covering the topics discussed at the recent FBA CFO Symposium. My name is Nancy Patton. I work at Saltmarsh in the marketing department, and I'll be your moderator in the background, kind of just going over the questions with you and help you along the way if you have technical difficulties. Before we begin our presentation, I just have a few housekeeping notes to mention. First, everyone on the line is muted to limit disruptions. If you have any questions, you're welcome to use your control panel of your GoToWebinar to ask your questions, and if we have time at the end, we'll answer them together. Today's webinar is being recorded, and you'll receive an email tomorrow with a slide deck and also the recording so that you can use it for future reference. Leading today's update, we have our dynamic duo, Josh Strickland and Josh Jackson from our Financial Institutions Advisory Practice. Let's see. And since we have such a short time with you guys, we're just going to kick it right over to Josh to get us started.
All righty. Well, thanks everybody for taking some time out of your day to attend this. We appreciate it. We do realize that it is June 1st. It's the first of the month, and so we understand for the accounting folks in the world that that does create that's a lot of work usually going on the first of the following month. As Nancy said, this is a shorter presentation. Therefore, feel free to put your questions in the chat there, and if we don't get to answer them during this, either Josh or myself will follow up with you afterwards. With any answers to questions via email or a phone call. Like she said, we were at the CFO Symposium a few weeks back that the FBA put on. This was a fantastic program. I was just really impressed with the speakers and the topics that they were talking about. I felt like these were the topics that were that are the most pressing at the current time in the industry at the time. We'll spend some time hitting the highlights. Some of y'all might even have been there as well, so hopefully we'll bring a little bit of our thoughts and what we're seeing out there to some of the things that were said. All right, Nancy, go ahead and go to the first slide. While she's advancing that, we'll go ahead and talk. This is mainly just the state of the economy, just the overall economic outlook. Right now, a lot of economists are, all the time, economists are trying to predict what the what's going to happen in the future. Unfortunately, that's a pretty difficult thing to do. But I think a lot of them together are saying they believe a recession's on the horizon, or maybe not that we're not there yet, but we're headed to one. There's, I think, a lot of the indicators out there that are kind of pointing that as well. We have an extremely flat yield curve. There is very, very little difference in the rate between a 2 and a 10-year right now, Treasury. That helps point, that's a pretty good indication of what's to come, or can help point that direction. The first quarter, there was unexpected contraction of GDP. I think a lot of people thought that we would have a contraction of GDP at some point during 2022, just not sure if they thought it was going to be, already in the first quarter. So that caught a few people by surprise, I think. And this week, actually, I started seeing some articles out there related to inventories and things like that. And, retail inventories seem to be ballooning as of recently. I'm sure a lot of this has to do with, supply chain issues in 2021, and, we are catching up with that at least, and that's a good thing. But at the same point, the level of increase in inventories is far surpassing, the supply chain catch up. I saw that Walmart and their distribution centers said they're 32% more merchandise right now as compared to last year, and Target said they have 43% more than a year ago. So that's, we're seeing quite a bit of increase in inventory. Especially, it's much faster than the increase in sales. So, another thing too is on the economy in general is, we heard that it would be a soft landing in the recession, or now it's a soft-ish. I think that, that change in language or just the soft in general is a little bit worrisome as far as, it sounds like, once we get there, we might stay there for a little bit. That's kind of what I think a lot of people are taking from their comments, that, hey, once we kind of land, we might be there for a little bit. So It's a little bit not, I mean, that's definitely not positive news, but kind of, what they're saying at this point. Next thing is the huge topic of inflation. I think everybody's experiencing this. We're seeing this all over the place. There has been just so much liquidity pumped in the system for the last few years. We're having to catch up with that, and that's rising prices, things like that. But the interesting piece is, it seems like consumers are kind of, essentially getting used to paying those higher prices. And, are they going to continue doing that? Or do we finally start seeing price increases slow down or even come back a little bit? As of now, due to all that liquidity out there, most people are just paying the higher price for everything. So it'll be interesting to see what happens, with the Fed's decisions, with investments and what that, do they finally sell? I mean, do they finally sell some of them back, things like that going forward. Another pressing question out there is, where are we at in the credit cycle? We've had this such a long period of this really, really good credit quality. It's like, when does that start to turn? Does it start to turn? Hopefully, the underwriting that we see out there in today's world is better than what, we had out there in the past few years, in the past recession. But still, everybody's kind of wondering, where are we headed with that? There tends to be quite a bit of a lag out there between consumer activity and the effect on commercial real estate. That lag's usually about 9 months. So, or historically has been. So that's the interesting thing to watch on some of these consumer things that we've just talked about, because that could eventually start affecting loan portfolios of some sort. Hopefully not near as bad. Hopefully we've learned our lessons a little bit, and going forward, it's not near as bad as it was last time. But there could be a little bit of a lag in it. I mean, there could be a little bit of a hit to quality at some point. All right, Nancy, go to the next slide. Then this is just a little bit of an industry update. Mergers and acquisition, obviously a very hot topic in the industry, continues to be. An interesting fact I thought about the industry that Jack really shared was that, community banks account for only 6% of the deposits in the United States, but are responsible for 60% of lending to small businesses. And that just like reiterates the point to me that, like, how crucial community banks are to the economy in general, because I understand that's a lot, that we're just talking about small businesses, but all those small businesses end up supporting larger businesses and, make the economy go around as a whole in our country. So, super important. They put, community banks play a super important role with that. One thing, a couple interesting things about the industry is, we're continuing to see less and less lending in the U.S. coming from banks. And, as of now, the statistic says, as of now, less than 20% of all borrowings in the U.S. are coming from banks. I think that's an interesting fact and tells you that there's a lot of other people now competing with banks for those loans. There's a lot of private money out there at this point in time, private debt funds. These people are in this space competing for loans and things like that too. Community banks do a fantastic job of, getting out there and getting decisions made quick, much faster than we see regional and national banks do. But these private debt fund people, they're even faster than that. I mean, they can, turn money around way faster even than the community bank can. And, the real reason for that is they don't have near the compliance cost and, don't have to make sure every T's crossed, I's dotted before they do a loan. I mean, they can do the loan, get the collateral and protect their interests, and they're done. So, that's becoming attractive, especially in today's competitive market, for real estate. People need a deal and they need the money now to execute the deal. And so they're paying a little higher rate for these private debt fund type people and doing that. Also, we're seeing some, quite a bit of competition from the fintechs. They're starting to gain some market share. They're building all kind of products on both the deposit and the loan side of the balance sheet, really. And a lot of their products are geared, obviously, towards the younger demographic, and they're doing pretty well with that. They're picking up a lot of loan funding in that demographic, and I think this will be a continued significant force of competition going forward. Looking at the merger layout or the merger and acquisition layout. Still, quite a bit of mergers and acquisitions going on. We had quite the lull related to COVID and kind of came out of that, and it's almost like we're making up for lost time right now. We've seen a few of those, quite a few of those recently. Pricing on those, looks like the national average has been about 1.52 times book. Interesting enough that Florida's average is 1.91. And so, Florida's still out, the multiple in Florida is higher than everywhere else. Also, the multiple paid has tended to been higher, based on the size of the bank. Banks over $1 billion are getting more than banks 500 million to $1 billion, and more than banks less than 500 million. But a lot of people want to be in Florida. It's it has the fourth most deposits in the U.S. So it's a big business state, and everybody, it's a great place to be and do business. One thing the mergers and acquisitions are running into some headwinds with, though, is the stock price of the acquirer. With the current trends in the stock market, the value of the acquired stock isn't quite as high as it was, say 6 months or definitely more than a year ago. And so, when they're doing deals of acquiring other banks and they want to give them stock, now they have to give them more shares of stock, which dilutes their current shareholders a little bit more. So that is a natural headwind that we're running into right now. And that's also creating a heck of opportunity for the credit union deals that we're seeing out there, where credit unions are purchasing banks. Those deals obviously aren't stock deals, they're full cash deals. And credit unions, like most banks right now, are flush with cash, so they're really willing to spend some of that getting acquiring a bank. And another thing, it's a good deal for the banks being acquired, because the value doesn't change a whole lot. Once the deal's set and the dollars are set, it's pretty much a done deal. So that's the headwinds that we're facing is almost making more opportunity for credit union deals, and making them probably a little bit more appealing to current bankers that are looking to sell their bank. So with that, I'll send it over to Josh and let him talk a little bit about securities and balance sheet and ALM type stuff.
All right, well, I appreciate it, Josh. As Josh said, I'm gonna try to summarize some of the materials that were covered at the conference related to investment securities, which, as we all know, is a very hot topic right now, especially with respect to the unrealized losses on AFS portfolios. So again, we all know the mark-to-market adjustments are currently, wreaking havoc on tangible book values, but regulatory capital for most community banks is not really impacted by unrealized losses that flow through other comprehensive income. So some community banks and even some of the larger regional banks are sort of looking past the unrealized losses almost, and they're starting to make their securities decisions based more on improving their net interest margin. Banks are generally in a pretty good place right now with respect to liquidity, and we're all pretty much asset sensitive. We always have been. So investing in securities in a rising rate environment might actually be in the best interest of a bank from an earnings perspective. So that's just a different way to look at it. The unrealized losses are scary, but some of those yields look pretty attractive right now. We've seen in the latest Fed dot plot the expectation that rates might actually start to decline again in 2024 and beyond. And of course, if that happens, there's probably going to be a lot of banks out there that wish they'd invested more in the higher yielding bonds that we're seeing today. On the other hand, there's, I'm sure, a lot of banks out there that are a little more sensitive to the growing unrealized losses in their portfolios, and we've actually seen some of those banks move portions of their available for sale securities into the held to maturity category. Now, of course, when you do this, the unrealized losses on those securities are essentially frozen, and those unrealized losses are accreted into income as a yield adjustment. But we're also seeing some banks, they're just outright classifying their new purchases as held to maturity from day one. So this has also led to another fairly interesting observation we're seeing in the industry with respect to held maturity securities. especially in some of the larger banks, the banks that are over $2 billion in total assets have more than doubled their held to maturity holdings in the last 12 months, while banks that are less than $2 billion have remained relatively unchanged with respect to their held to maturity securities. We're going to talk a little bit more about CECL in the next slide, but CECL is also expected to have more or less a limited impact on held to maturity securities. Some of the models we've seen recently appear to show reserves could be 5 basis points or even less on certain types of securities like municipals, for example. Subordinated debt and corporate bond issues in the HTM category will probably require a higher reserve than the 5 basis points estimated on munis, but it still really isn't expected to have a huge impact on reserves. Nancy, if you want to go to the next slide, we'll go over some balance sheet considerations. As I mentioned, most community banks are asset sensitive, so generally balance sheets are pretty well positioned for rising interest rates. We've seen deposit growth continues to outpace loan demand by a considerable margin, and this is also seen just in declining loans to deposit ratios across the board. I don't think that's really a surprise. Deposit products should be much slower to reprice as compared to rates on earning assets. The banks are still pretty flush with cash. We haven't really noticed any significant ramp up in market competition for deposits. So there really doesn't seem to be a lot of motivation for banks to increase their rates. As market rates increase, now may be a really good time to reassess some of the assumptions that are used in calculating the various model inputs for ALM purposes, such as like deposit betas and things like that. Next slide, Nancy. Okay, CECL. All right, another hot topic. I'll get us started with some considerations for on the security side. Securities held to maturity are going to be subject to the CECL methodology, while available for sale securities are going to be subject to a separate credit loss methodology that's found under the new accounting guidance. On available for sale securities, the measurement of a credit loss should be done at the individual security level, right? And it's going to be based on a discounted cash flow approach, but it's important to keep in mind that this is really only going to be required to the extent that you have actually identified a credit loss in a security, which is probably going to be pretty rare, I would think. So just that's one thing to keep in mind. There are a number of other non-credit related reasons why your fair value is going to be less than your amortized costs. It could be changes in interest rates, which is pretty much what's happening right now. In those cases, those unrealized losses are going to continue to be reported in other comprehensive income. It's not going to require any sort of like impairment measurement on those securities. We should also keep in mind that CECL does not require an allowance for credit losses on held to maturity securities for which the expectation of non-payment is zero based on historical credit loss information. And examples of those types of securities are going to be, of course, U.S. Treasuries, certain mortgage-backed securities guaranteed by federal agencies such as Ginnie Mae and Fannie Mae and so on. In those cases, you really don't need to be doing much with your CECL analysis on those types of held to maturity securities, because again, the expectation is you're not going to have any losses there. Josh, I'll kick the CECL question over to you for the loan piece.
Yeah, I appreciate it. So yeah, they did not talk about the loan side of CECL a whole lot there. That was probably literally the only topic I thought that really important topic that wasn't talked about at the symposium, but is kind of a, I say it's a burning question. I think it's less of a question now than it has been in the past. It seems like when this first came out, everybody was, super concerned that this was going to change lots of the amount of allowance that we needed for loans and things like that. And now it seems as the closer we get to it, the less it kind of seems like, well, it's going to change how we do it, but we don't think there's going to be near the difference in calculated allowance as compared to, what we thought when the guidance was first issued. We have some people that are running stuff parallel now, and so we're kind of getting some feedback from those people that, hey, it didn't change it near as much as we thought. It's still, and also that we hear a lot that it's actually quite similar, for most people. I mean, depending on what methodology you use, but the most common probably for community banks, that it's very similar to what we're doing today. So, it sounds like it's going to be a lot less of a change. And I think that change even gets echoed too, especially if you look at the public banks that, have already filed for past quarters of financial statements. You can see the quarters where they adopted it. You can see that the allowance went way up. It kind of is probably skewed a little bit because of that, because COVID happened kind of in that first quarter of 2020 when they were putting it on there too. So you saw a large increase in allowance for that. But still, even, I mean, they did, show exactly how much was related to CECL, and it was a significant impact. And then you can see a lot of those folks took, through 2021, a lot of those larger banks had net credits to the allowance where they were taking it out of the allowance and putting it back through earnings because I guess they overshot, essentially their initial recording of the allowance for loan loss for that. So that, it sounds like if you were on a steady pace with that, it would have been, relatively the same amount as we have out there today. Something to consider is the look back period for that. Right now, if you look back at that, if you do a 3-year look back or a 5 or a 7, there shouldn't be a whole lot of loss out there for your bank or even your peer banks for that during that time period. I mean, it has been really, really good on the credit loss side for several years now. So, it doesn't really change the calculation a whole lot, really, if you pile on those additional years of loss there. I mean, it does impact it, but it's not, a significant amount. Now, the economy starts shifting or things like that, yes, it will, I think we're very, very likely to see some, some changes and some impacts to the allowance calculation. But until that point, going forward, at this point, I don't think it's a big deal. So just something to watch, and it's going to be interesting to see how it evolves and to see how many people, how much we add on to the allowance with that one-time, credit through equity, which is a huge help. It might, spur a few people to add, a little bit an additional amount to the allowance because you don't have to run through the income statement, So naturally, some people might, get the allowance a little bit higher level. They were anyways, but we're going to go, be easier to do it through equity than have to hit the income statement. So we'll see what that brings when it gets implemented. I think that's about all we had from here. Also, just want to give a little bit, plug here for our CFO roundtable we do. We usually do these twice a year. These are good events just to come to join and hear what some of your peers are experiencing, what's going on in industry, the industry in general. People can share, we usually talk about recent exam experiences, what's going on in various markets, things like that. So that's a good thing to sign up. And also, we have Bank Talk 2022, which will be another all virtual event. A lot of good speakers, various topics from pretty much all aspects of the bank, I would say. So it's a good thing to attend.
Yeah, I always learn something new at Bank Talk, and I think the CFO roundtables are extremely beneficial. I know I always get a lot out of those discussions. It's just neat to hear what different folks are seeing in different parts of the state and even in different parts of the Southeast. With respect to just the examination experiences or just whatever the case may be. I think those things are extremely beneficial.
Yeah, it is interesting how those, you have an exam team at one of those banks and they go to the next one and it's this, they're like, hey, we just got dinged for that too. And you're like, yeah, we just heard that, and that helps maybe the third person on the call that they were coming into in, 3 months, they could prepare for it, know a little bit about what they're going to be asking for. But we do hear that a lot on those calls.
Absolutely.
Well, thank you so much, Josh and Josh. A very nice recap of the FBA CFO Symposium. And I know that you're no strangers to some of the people on the call, and so I'm sure they enjoyed seeing your faces today. My slide's not changing, but I have Josh and Josh's contact information at the end of this presentation. So if you guys have any questions at all, feel free to email them or another member of our banking team, and they'll be happy to get back with you. But I think we'll wrap up a couple minutes early from our webinar. We have no questions at this time. And while you guys are leaving, a short survey will pop up on your screen, so feel free to take that. Let us know what other topics are interest of you, and we hope you have a great rest of your day.
Really appreciate everybody's time. Thank you so much.
Yep, have a great day.
Bye, everyone.